Good morning, traders. Curtis from Beyond Back Testing here. Here you can see some of my signals been producing really well this morning. We've had a strong reversion, strong move up. I took a few of them. Certainly not didn't maximize them to the extent that they're producing. Normally don't trade after hours or in the morning this time, but with the market moving so fast during the day, it's actually moving more slow, more at a more human-like pace right now than it was during the day. So I did. I think I put up a 170 netted roundabouts there. Certainly not very much. Traded super small. Missed a lot of my best signals. Had some really good, great signals. Really producing strong. But I want this topic's a little different. I'm going to talk about equities versus futures. Hopefully, kind of be entertaining, educational. I'm going to talk about my history and experience, and I'm going to talk about kind of my thinking going forward with equities versus futures. But I've always felt there's a mystique or a nostalgia or a draw to futures because of the floor, the the floor trading, the history, I always thought it's a privilege to trade futures. Even if you lose, it's like a privilege. You're a futures trader, right? So that's always had like a appeal to me, and I don't know where it got set, but maybe from reading about floor traders and things that obviously don't apply today to that extent. But I think futures has a draw for me. Has always had that appeal to me, and it's a regulated market and all. But what I want to look at is the concretes, the rational. So obviously there's an appeal to futures, but what about let's look at it from a pure non-emotional type of a perspective. One of the things that drew me to equities was I see a lot more professional traders posting real money results trading equities and stocks. And I said, okay, I've seen traders post more real money results, and you see prop traders who were trading equities. But part of the reason you see prop firms in equities or seeing prop firms in equities is because of the PDT rule, the pattern day trader rule. Right? And I didn't fully understand this, but and because the Reg T margin requirements. Reg T states you can only 2x leverage intraday. Whereas futures, you get plenty of leverage. There's no PDT rule. And you don't need a lot of capital. So the the um, the the prop firms and equities started from the arcades, and there was a violent incident at an arcade, and this is where these prop firms originated. That's why there's prop firms in the PDT rule. Well, let's say that the PDT rule originated because so some events, the traders lost money, became violent. That that caused regulation that caused the PDT rule, which gave these prop firms an ability to come in and say, "Hey, we'll give you leverage, give you margin." The other reason you see, I believe, that you have more successful equities traders than futures historically is because a prop firm can start an equities trader off of 100 shares, which is typically how they start. They start a lot of traders that's been known, or a very small size, and and so they allow you to trade and with essentially maybe like 10 to $50 of risk per day, which is just give you just a tiniest bit of risk per day, and that allows a trader to develop. And futures are very large contracts. There's historically there's been no way to do that. There's been no way to progress. It's all or nothing. The futures are very big contracts, but with the introduction of the micros, now there's a way to progress more similar to equities. And one of the more recent appeals to equities trading has been the commission-free trading introduced by Robinhood. Now, Robinhood, it was later discovered, had disadvantaged their customers significantly with their pay for order flow trading. The way that works is, if you don't know, is that your trade is routed to a HFT firm, which then takes the orders and kind of does what they want to with them. But now that's become industry standard. And one of the reasons I went back to equities actually was because of the commission-free trading. I went with TradeStation, and I learned that TradeStation, if you use their routing engine, if you use their desktop platform, version 10, their latest one, there is a significant lag in placing orders if you place many orders. You don't have to place a ton of orders. Sometimes it only shows up after you place more orders, but in equities, there's significant lag. And it happens, I've seen it on two computers of mine, an i9 and another fast computer, so it's not the computer. and there's significant lag, I can't execute in TradeStation. I can't have any confidence of what I'm doing there because the lag. And I don't know if it's their I don't know where the problem is, if it's a factor of the commission free or if it's a factor of the software. But that really hurt my confidence in trading equities is when I seen that I couldn't, that sometimes I get delays of 10, 15 minutes on some days for my field. I can't be trading like that. So that just killed my confidence when I went to equities. Um, I didn't have any when I placed trades on futures with Rhythmic, with CQG, with AMP. Okay, even with OpenECRI. When I started trading back at 10 years ago, was what is now like futures online. It was just a cheap broker. You get instant feels. You get to see your working order there. There's not this. I've never experienced 15-minute delays on orders. I had one hung order 1 year. And I did have problems with interactive brokers. That's another story. And that's why I recommend people to go to a futures, dedicated futures FCM. Like if you're going to trade futures, go to AMP, go to a Ninja Trader. Somebody who just specializes in that, because I did have some problems with. But that's historically you don't have that type of problem. So let's look at it rationally. We'll break down the pros and cons. But one reason you don't see the prop trading in futures is because first they couldn't start you off at, give you that such a tiny risk, the prop firm. So nobody's going to take a risk on a trader, having to give them real money, right? And two, there's no need. If a futures trader can produce, there's no need for funding. There's no need. I mean, now today we have these prop trial firms, and we have the nice thing to the micros, which is that bridging the gap. Okay, but let's take a look at why I went to equities, why I came back to futures. So one of the pros, if you're talking about pros to equities, would be one argument is, hey, there are thousands of stocks, so you can more easily find an edge, right? This is the idea that it's not how you trade, it's what you trade, right? So if you can find something that's moving on the day, you can find something with news backing or moving it, then you pick what's moving with like a trend play or a trend day, and that's the idea. Or you pick a couple different names. You may pick 2 or 3 strong names that goes long, 2 or 3 names that go short. You can do stuff like that, which that makes a lot of sense. You can kind of be hedged or delta, try to hedge your delta, so to speak. And we'll talk about the cons of this too. So that's one advantage, right? There are thousands of stocks you can. I'll not say you can find more as an edge. I'm going to say you can more easily find stuff that moves, right? It may or may not be an edge. That's the implication. The idea of it may not be true. That's why another pro trading equities. You can trade small, okay. You need the 25K for the PDT, but you can trade very small in equities. What else? What's another advantage of equities? Yeah, you may be able to find both long and short trades on the same day better, or uncorrelated stuff. That's kind of maybe. So let's look at the cons, okay? And you can commission free, but the reality is most equities traders who are professional pay commissions because of the routing problems that come with commission free trading. So we'll say that's probably not going to be applicable. Let's look at some of the cons now. The cons are, with those thousands of stocks, if you're changing stocks first, operationally, you need a scanner to find those stocks and a way of identifying the opportunity. And so you'll need some way of identifying the opportunity. Second, the other problem with trading thousands of stocks is you won't have any knowledge, specialized knowledge in trading those stocks, right? And I find this to be very key, is that if you don't think about, the one nice thing about futures is nobody, presumably, right, nobody has any advantage, has any knowledge of anything. And so it's a pure trading it's an application of pure trading because nobody knows anything. And if you think about now, one way to think about it is kind of I would say the negative view is that, hey, if nobody knows anything, why are you trading it? But really, that's the best you could hope for is that nobody knows anything. Because if anybody knows anything, they're going to know more than me or you, right? They're going to know more than us. And with stocks, you have firms who specialize in those stocks who obviously know more than me or you. So that's one of the problems with trading those stocks. And if you don't trade the same stock, you don't know how it moves. So a lot of times you'll find equities traders who say, "Oh, I've got thousands of stocks," but the reality is everything moves to the market. They end up trading a couple different names, which are just basically they're basically just high beta market names like Apple or the Spiders, right? Which is the same name as S&P 500, right? There's just ETF. So. And that's one of my problems is anytime I traded equities, I ended up just trading a couple different names because, there was no, what would I trade? So that's the other side is that you end up just trading basically futures anyway. The cons, about more cons, the PDT rule, right? The PDT rule, you need 25K in your account. So that's the downside. Even if you have the money, you have to keep it in your account. Another con is the Reg T margin requirements. Another con would be, again, you have to go to you have to be very selective if you're a broker to get your professional routing and stuff like that. And you have to also deal with routing, which is another thing that we don't have to deal with futures. It's a technical matter that doesn't interest me any. Another con. A big con, this was the deciding factor for me to move back to futures. If you're going to deploy a portfolio, if you're going to take a portfolio approach to your trading and run a portfolio of systems, and equities eventually, one of the reasons I quit or moved back from equities is I had systems that were producing, but scalability. When you look at scalability, the PDT rule of 25K is not too big a deal in isolation. It's okay, that's not too big a deal. But scaling in equities, it becomes much more difficult, in my opinion, to do that safely because of a few reasons. First, if you're building your automated strategies, you have to pick unless you're doing unless it's stock specific. In other words, you're trying to pick a stock on the day, or try to pick the 20 best stocks. Your strategy is basically stock specific, and why there's no stock I could pick that's better than a futures contract, because eventually, if I'm automating, let's say on different stocks, if I'm automating, there's going to be some kind of news or something that's going to come out and eventually impact that automation. And it's going to be much more prevalent in equities. And if you try to scale that out with automated trading, it becomes difficult because there's more news impact events. You have your Reg T margin requirements come into effect when you're running multiple strategies. And also, there's just not a good way of selecting. Anything you would select would be better, future would be better. And now some people talk about the tax implications and all, but there are always tax strategies for whatever you trade. So I'm not going into the tax benefits. Those are well known. The futures have some tax benefits as well, in terms of short, long term. But there are ways of structuring taxes in either case. But this was the big thing for me, was scaling, building a portfolio in equities. I said eventually, and this gets back to another thing. In equities, when you place a trade, let's say you want to place a small trade, you'd have 50 to 100K on that trade with a relatively medium-sized trade, and you don't have at least I did not have the same quality of execution in futures. When I execute in futures, I can put a stop and target in place, and that, because you have diversification, the probability of a crazy swing from nowhere is less likely. In equities, there are specific things to be aware of, such as freezes, such as stock halts, right? That can happen in certain stocks. It can be halted. It's not common, but it can happen. There's news events. That's a big risk. That's a big risk in equities that you don't have to the same extent in futures. So this was a big thing for me too. Is that okay? You can always lose, and this is something that Mark Melnick also talked about. I guess he's somebody not to mention now, but I thought it made a lot of sense, and that's why he traded options, because he said, look, you could lose. Realistically, I mean, frankly, you could lose a lot in equities if something happens, if you're not completely on your game, so to speak. Um, so yeah, that made a lot of sense to me with this potential to lose money, right? And so all in all, it's gonna be hard to scale. If you trade, and the other thing is, if you work on your trading, if you're more of a intraday trader versus most of your equities guys are probably the type of trader who goes in and says, okay, I think market's going to trend today. I'm going to buy it, open today. I'm going to hold it. Okay. Because that's, what are you going to do? Right. I feel like that's probably your standard equities trader. Let's buy something. Let's pick a group of stocks to buy off the open and hold them. But if you're more of a type of trader who does targets and things intraday, to me, again, futures seems to be better to support that type of trading, because you can learn your instrument. You can learn a few instruments well. You can specialize, and if you're trading intraday and you don't know the stock, it just seems like it'd be very difficult. Now, to the I guess the argument would be, well, yeah, we pick a couple stocks. If you're a professional equity trader, we pick I pick 3 or 4 things I trade on a frequent basis, but I have flexibility to change that. So that makes sense. I mean, I understand that. So this is the pros and cons as far as I see it. Now, for equities. Now, for futures, let's look at the pros, right? And you have many futures now that are non-correlated, or that are unique markets, like crypto. You can trade crypto, energies, equities. Okay, so you have the full basket. You have micros now that are small. Okay, no need for no PDT rule. Very good routing, very sound, fast order placement, right? That comes off the bat. Regulated. Of course, that's a problem equities, so they're regulated. And importantly, scalable. Okay, there's no need for scanners. And one thing I would say is that if you're going to trade futures, I've been an ES trader, but sometimes the markets went dead and it makes it difficult to trade. But today there's the ES, of course you have the NASDAQ. If markets get too slow, you have the crude oil, you have Bitcoin, and so there's lots of there's plenty of, if you're going to become a master in 3 or 4 markets, you can have 3 or 4 markets there that are completely in different sectors, different have different quality. So that's great. So you can practice small. So yeah, I mean, we'll say scanning is simplified. Decision of market to trade is simplified. So yeah, futures to me just has a lot of advantages. Cons, I guess the con would be commissions can be costly. I mean, that could be true in equities too. You have to find an edge. Liquid, highly traded product. Some people say that's more difficult, but overall, I see futures as just being superior. If you're going to be doing intraday trading, even if you're going to be the type of trader who buys at the open, you still your decision matrix is simplified. You could still look at different markets. You get diversification built in. You can be less prone to news / less news prone. Lower margin requirements. You can keep less in your account. You can put your stop loss in. You can put liquidation in. I feel like it's less risky, really. That's one reason I put equities. It's like, so in summary, I would say this. This is the way I feel about it. I'm sorry for going on too long. But if you're going to trade equities, if I would trade equities, I would want to have a mentor or trade with a proven prop firm that can show that they have something to offer. Okay, I think this is the deal in equities. If I'm trading equities, now I will trade equities for position trades in certain stocks and things, but like for day trading, if I was actively trading, I think first you have to go to the right broker. Okay, you can't just go to any broker, or else you're going to be disadvantaged with like I was with the orders. So you're going to have to find a broker, the right broker to go so that you can place the orders and have a confidence in your orders. But beyond that, I think that you would need to find a mentor or a prop firm because there's just so much can go wrong. And that's true in futures too. But if you stick to the ES, you stick to to products that are traded, then it's less likely. It can happen. Crude oil went negative. There are disasters that can happen in futures too. Obviously, when I think about futures, I'm not thinking about corn or I'm not thinking about the ags. I'm thinking about more like primarily your equities, maybe in your energies, maybe your Bitcoin, stuff like that, where your broker's going to liquidate you. So that's what I'm thinking about. Again, with crude oil going negative, that was a disaster that did happen. But overall, I feel like futures is less risky. I feel like if you're going to be building out a portfolio or automated strategies, it's just much more sense. I'm going to trade I'm going to build an ES strategy. I'm going to build a crude oil strategy. You don't have to wonder, am I going to build a Disney strategy, right? Or a Delta Airlines strategy, right? So if you're not going to run the Reg T margin requirements. You're going to there's no PDT rule. There's you have against the historical component. So yeah, I'm squarely back in futures now. I guess it's like if you can't trade something, it's like you always want to do it, like because I didn't have the PDT requirements for a longer time, and so I was like, I felt like I was missing something. But once I was able to go to equity, I was like, I'm not missing anything, and so I'm squarely in futures. If I were to trade equities, I would say I would try to find a mentor who's posting good numbers and or a prop firm, a legit prop firm, and learn from them because there's so many mistakes. I feel like there's much bigger risk of losing a lot of money in equities. And, for equities, I'll swing trade them. I might put a position on them on the hold without leverage for a long period of time. That's how we'll look at trading equities. And I do have I do have a Delta Airlines trade on. I'm sure I'm losing big on that now as the markets drop, but that's how I see equities. But for real trading, for algo trading, for real-time trading, I see it as futures. Now, some of the, let's make it more cons. One con is they are highly algo driven, and the algos are out to get you, out to get everybody. So they say, but they are highly algo driven, and they are specialized, and so that's where the micros are nice, because you can trade small. If they move too fast, that would be one of the only con is they do move very fast and highly algo driven. The alternative to futures, the kind of between that would be options. Would be potentially trading options. You get the leverage. It's kind of between the two. It's a unique instrument, certainly, but you don't have the liquidity, right, with options. It could be useful for certain types of trades where you don't have to worry about stop losses and things, but you don't have the liquidity. It's a downside. It's again a kind of a specialized thing, and it's probably going to be more for your intermediate trades, like 1, 2, 3 days versus actual day trades. So that's the breakdown of futures and equities. I would say futures has the advantage, pretty much hands down. unless you're going to go to a professional who trades equities. Get with a solid prop firm. You know, get with somebody who knows what they're doing and really learn from someone who who's and that's, I think, the difference too, is that these equity traders are really on point. I've noticed that trade, and it's not something I think that's more for an individual. Okay, that's all.